All right, let's jump right into it. If you're even thinking about buying a home, your credit score is probably on your mind. But here's the curveball. What happens when you find out you don't have just one score? You actually have three. Today, we are going to pull back the curtain and decode exactly how mortgage lenders look at your credit. So you go to check your credit and you see three different numbers staring back at you. It can be a little confusing, right? What gives? And more importantly, which one of these scores is a lender actually going to use for your mortgage application? This is the million-dollar question, isn't it? Do they just pick the highest one? Maybe the lowest? Do they have some kind of complicated formula? Let's figure it out. But before we get to the real answer, we have got to talk about the biggest myth floating around out there because a lot of people get this wrong. That's right, the most common assumption is just, well, it's wrong. Lenders do not add up your three scores and take the average. So if that's what you were thinking, don't worry, you're not alone, but let's clear that up right now. So if they're not pulling out the calculator to find an average, what's the big secret? How do they do it? It turns out the method they use is really specific, and honestly, it's way more straightforward than you probably think. And here it is, the moment of truth. It's called the middle score rule. And once you get this, the whole process is going to seem crystal clear. Okay, first things first, why are there even three scores to begin with? Well, your lender pulls a report from the three major credit bureaus. That's Equifax, Experian, and TransUnion. Each one has its own slightly different way of calculating your score, so it is completely normal and expected for their numbers to be a little different. And this brings us to the rule itself. It's so simple, you're going to love it. Lenders look at your three scores. They toss out the highest one, they toss out the lowest one, and they use the one that's left right there in the middle. That's it. That is the magic number that determines your eligibility. Let's look at a real-world example here. Say your scores come back as a 776, a 790, and a 780. All the lender does is line them up from low to high. So 776 is the lowest, 790 is the highest, which leaves 780 right in the middle. That's the score they're going to use. See? It really is that simple. Now, what if you're applying with a partner or a spouse? Pay close attention, because this is where it gets really important. For a single person, it's easy. They just use your middle score. But for two people, the lender finds the middle score for each of you. And then, and this is the key, they use the lower of those two middle scores for the application. That is a critical detail that can make a huge difference. Okay, so now you know the rule. The next logical question is, what can you actually do about it? How can you take control and make sure that middle score is as strong as it can possibly be? Well, there are 5 main things that shape all 3 of your scores. First, and this one's the king, is your payment history, paying your bills on time. Next is your credit utilization, which is just a fancy way of saying how much of your available credit you're using. Then you've got any major negative marks, the age of your credit accounts, and finally, any recent applications for new credit. All 5 of these play a part. Let's zoom in on utilization for a second, because this is one of the fastest ways to influence your score. Now, you definitely don't want to have your cards maxed out, but funnily enough, lenders can also get a little nervous if they see zero activity at all. They want to see you can handle credit responsibly. That's why there's this sweet spot, usually somewhere in the 30 to 45% range. It shows you're using credit, but you're not overextended. So with that in mind, here are some quick actionable tips. Get those card balances down to hit that sweet spot. Whatever you do, don't close your oldest credit cards. That long history is like gold for your score. Absolutely avoid opening a bunch of new store credit cards right before you apply for a mortgage. And finally, if you have any outstanding issues, now's the time to address them. All right, we've covered the rules and the strategies. Now let's get to the bottom line. What numbers are we actually shooting for here? What score do you really need? This table breaks it down nicely. You can see that different loan programs have different minimums. For instance, FHA loans, which are super popular with first-time homebuyers, often have a lower entry point, right around 580. For other loan types, like a VA loan for veterans or a standard conventional loan, you're generally going to want to aim for a 620 or higher to be in a good position. And that's really the main point of all this. It's not about some complicated secret formula that nobody understands. By knowing the middle score rule and knowing the targets you're aiming for, you're suddenly in the driver's seat. You can prepare your credit with a very clear goal in mind. So, I'll leave you with this question. Now that you know the rule, what is one single thing you can do just this week to start boosting that all-important middle score? Thanks for tuning in to this explainer.